Hey everybody, I'm gonna give everyone a few more minutes to hop on the call here. We'll get started at 10:30, and then if you have any questions, don't be afraid to put them in the chat. Have some more people trickling in. Also, I have some note takers requesting to hop in. We will be recording this webinar and we'll be sending it out to everyone that's registered. So you'll have a copy of this recording. We'll also send you all the slides as well as the PDFs used in this webinar. About to be 10:30 right now. Give people about a minute or two. Probably their clocks are going off uh, to hop on, and then we will get started. Before we get started, I don't know if you saw that question come up, Jack, there. Is it able to be used with the spouse for a joint, or is it only?
Single life. There's a single life benefit. But the spouse can do a spousal assumption and refill the death benefit. And we'll get into that.
Get started here in 1 minute. All right, well, I'll get started here. If people come in, they'll come in. Good morning or good afternoon, depending where you are in the country. Welcome and thanks for taking the time out of your guys' busy day to be here. My name's Ephraim Steigerwald. I'm with Dunhill Insurance. This is Jack Riley. He's with Lincoln Annuities. We're going to be talking about the Lincoln Estate Lock today, the guaranteed income, lifetime income, with the death benefit for your clients. For those who don't know us, Dunhill Marketing and Insurance Services is a family-owned brokerage out of San Diego. We've been helping independent agents and advisors grow their business for over 30 years. We're a full-stop IMO. We do over 100 million in annuities a year, and we're experts in product selection, annuity design, as well as illustrations. We specialize in ultra-high net worth clients, athletes, celebrities, and impaired risk cases with underwriters, CFPs, IRS enrolled agents, and premium finance experts on our team, all at no cost to you. Quick housekeeping. Everyone's on mute, so drop your questions in the chat as we go. We'll get to them at the end, and we'll keep this to around 45 minutes. We'll also send you a replay with all the materials used during this webinar. Now I'm excited to bring on our presenter, Jack Riley. Again, he's our internal annuity expert over at Lincoln Financial. Works with these products every single day, and there's nobody better to walk you through how Estate Lock delivers income for life and protects legacy. So I'll let Jack take it away here.
Thanks, Ephraim. Hello, everyone. Thank you for joining us. For those of you I haven't had the pleasure of speaking with, my name is Jack Riley. I'm the sales vice president for annuities at Lincoln, and I support Ephraim and the team at Dunhill. You may have heard from Lincoln's CEO that our fixed index annuity sales are up over 90% year over year, and that momentum has continued. And wanted to share a few of the ideas what we're seeing, particularly with the income and legacy combo on the OptiBlend Income with the Estate Lock. Before I get into it, I'll address the elephant in the room. Yes, my eyebrows are real. I didn't tape them on my face when I woke up this morning, so figured I'd get that out of the way so I could have your full attention. And we're going to use this client guide to make the conversation simple and visual. You know, right here on the first page, it says it perfectly: make your income last a lifetime. And that's really the core purpose, helping clients retire with confidence in a plan. And the new OptiBlend Income with the Estate Lock gives clients the ability to lock in growth, income, and legacy all in one strategy. Typically, clients must choose between taking income or leaving a legacy, but with Lincoln, clients can prioritize both. You can really have your cake and eat it too. So you can lock in protected growth. So it's a 10% simple roll-up that's guaranteed for 10 years. So say, for example, $500,000 deposit, 10% of that would be every year the client defers his income. Their income base is growing by that $50,000. Number two, protected lifetime income. You know, of course, this is guaranteed non-reducing lifetime income. So even if the account value does go to zero, that check will never change. And of course, you know, arguably the most important component, locking in the legacy. The estate lock is a non-reducing death benefit, meaning income withdrawals do not reduce the death benefit. So as long as the account value is above zero when the owner passes away, Lincoln will pay the full initial premium to the beneficiary. So locking in the growth. So a few key things to highlight. I mentioned the protected income base grows by 10% simple interest every year. The percentage for the lifetime income also increases as you get older. So the payout rate is based on the age you start taking income. Income can start as early as age 59 and continues even if the account value goes to zero. So in this example, you'll see a $500,000 deposit. 10% of that would be the $50,000. So every year the client defers income, that income base is growing by $50,000. What you'll also see is each year that payout rate is increasing. So the income base is going up and the payout rate is increasing. Number two, you know, for a lot of you, this is pretty straightforward, but guaranteed non-reducing lifetime income. So even if the account value does go to zero, that check will never change. And of course, you know, one of the most common concerns I hear, should I use my savings for income or preserve it for my beneficiaries? And typically you've had to choose, but the estate lock helps clients avoid that trade-off. So as long as the account value remains above zero, Lincoln pays the full initial premium to the beneficiary. So if it's a spouse, you know, they'd be able to take that, you know, full premium, and they could open up their own annuity, or they could do whatever they want with it. Or a non-spouse, they would have all the typical annuity claim options, where if it's a non-qualified, they would have lump sum, 5-year deferral, or non-qualified stretch. And if it's an IRA, they could do the lump sum or the 10-year deferral or the Benny IRA in certain cases. Something to note, the income is flexible. So you can turn it off, you can take less, you can stop it at any time, and you can turn it back on. So say, for example, somebody was taking income for 15, 20 years and they're worried about that account value getting low. At that point, they've got a few options. Option A would be, keep taking that full guarantee of income. That will never reduce. Option 2 would be take a little bit less income. So if, they want, they could take 4 or 5% withdrawals, and that would also not impact the death benefit, or they can just turn it off. It's also RMD friendly. So, one of the strategies we'll discuss is that RMD client. But while this is new to the fixed index annuity, this is not new to Lincoln. We launched this on our variable annuity and did over $1 billion in premium in this strategy alone in the first 12 months. And because of the demand, we figured why not add it to the fixed index annuity, but also see where we can enhance this. So really, there's a few areas where this strategy wins versus its variable annuity counterpart, because it is available in the variable annuity market space. Number one, of course, is 100% downside protection. Number two is lower fees. So the all-in cost on the OptiBlend Income with the estate lock is 1.55 compared to around 4% versus what you'll see on a variable annuity. It's a higher roll-up. So it's a 10% simple roll-up on the FIA versus a lower, usually 5 or 6% on the variable annuity. And it's also higher guaranteed lifetime income. So 100% downside protection, lower fees, higher roll-up, and higher income. So that's really where it wins versus the variable annuity counterpart. Where it wins versus other FIAs, most income solutions are built to insure the client if they outlive their money. But Lincoln is the only income solution that insures clients if they live too long, but also insures clients if they die too soon, or insures their family if they die too soon. So, I live in Arizona. I live near a bunch of reservations, and there's a lot of casinos. So you could use this roulette analogy. The highest guaranteed lifetime income is betting it all on black. You're betting that the client is going to outlive their money. The estate lock is like putting your chips on red and black, where if you outlive your money, you're still getting guaranteed non-reducing lifetime income. But if you pass away too soon, your family got that significantly enhanced death benefit. So you're really playing both sides of it. So really, the highest income option is really an income only focus, while the estate lock is really a family outcome focus, giving brevity and longevity protection, meaning you're protected if you live too long, but you're also protected if you pass away sooner than expected. So when you're looking at a great insurance product, you want something that will get you as much money out of the insurance company as possible. And as far as maximizing total dollars paid to the family, in other words, the total family outcome, the estate lock does that better than any income strategy as far as total dollars paid to the family when you look at the income that was paid as well as the death benefit. So, if you have clients living into their late 90s or relatives of your clients living into their 90s, hundreds, that's a scenario where the higher income option could mathematically make more sense. But I'm not saying it's this or that. This is a way to supplement their income plan and legacy and show both options, because truthfully, nobody has a crystal ball and knows when their client is going to pass away. So again, we can maximize the total family outcome, and we can ensure the client from outliving their money while also maximizing total dollars paid to the family. So I'll show you a sample illustration. This is a 65-year-old with a $500,000 deposit waiting 1 year for guaranteed lifetime income. So you'll see waiting 1 year. In that green column in the protected income base, we're getting that 10% step up, bringing us to the $550,000. And then we turn on that guaranteed lifetime income. What you'll notice is that as the account value gets lower, on the right-hand side, that death benefit is locked in. You'll see that purple shield, $500,000. So income withdrawals do not reduce the death benefit. As long as the account value is above zero, Lincoln pays the full $500,000 to the beneficiary. In those first few years, you'll see the account value is higher than what they put in. So of course, if the owner passed away, the beneficiary would get the higher of the two. But if it is lower, we're paying the full 500,000. In this scenario, the account value runs out when they're 92. So, that's a scenario, again, I talked about it mathematically. If clients have relatives living into their late 90s, hundreds, higher income option could make sense. But for anyone else, if you truly don't know when they're going to pass away, they're going to get a whole lot more dollars paid to the family between the income and the death benefit. So now that we've talked about how it works and what it does, let's talk about some clients to consider. So number one that we talked about is, of course, the income legacy trade-off. Any client, wanting guaranteed lifetime income, but also wanting to leave a meaningful death benefit. Another big one that we see is large age gap. Joint income is very tough to come by for a 67-year-old and 55-year-old. So we often see the older spouse set up that younger spouse with the non-reducing death benefit. And they can do what we call the W strategy. Say, for example, I open up an estate lock on myself. I turn on that guaranteed lifetime income and I'm spending it down. When I pass away, it refills back up for my wife. She opens up her own estate lock policy. She turns on the guaranteed lifetime income. She spends it down. And when she passes away, it refills back up for our children. So again, that when it does pass away, if the spouse were to do their own estate lock, of course, that would pay full comp. And then the beneficiaries, the non-spouses, would be able to do, lump sum, 5-year deferral, or that non-qualified stretch. Another big one is RMD clients, folks that have to take RMDs but want to leave something meaningful behind. This is a great way. This is RMD friendly. So oftentimes our income guarantees are higher than what the RMD would be. But, if for older clients, if the RMD does happen to be higher than the guaranteed income, that is not a problem. So this is totally RMD friendly. Clients can take that RMD annually, and that will not impact the death benefit that they're leaving behind. Another big one would be uninsurable clients. Folks that can't qualify for life insurance, but want to leave something meaningful behind. As many of you may know, there's no underwriting with the annuities. So folks that, may have health issues or may have some kind of issue, we can do the estate lock death benefit for those folks. On the flip side of that, here we have a brochure specifically for this as well. Turning it into long-term care protection. So for those people that are insurable, you could use the estate lock income to fund a life insurance or a long-term care policy. So, whether that's a policy that's at Lincoln, we can send it directly to that policy, or if it's another carrier, for example, one of my top advisors that uses this estate lock strategy for a handful of his clients, he sends the income directly to their Mass Mutual life insurance policy. So, we can send it directly to another carrier, whether that's their long-term care or life insurance, or even internally here at Lincoln, we can do that as well. So again, some clients to consider, income legacy trade-off, RMD clients, large age gap, uninsurable clients, insurable clients that could use the income to fund a life insurance or long-term care. But there's also some of these other scenarios as well. So optimizing qualified charitable distributions, charitable remainder trust. So again, this income can go to a charity, or they can have the death benefit go to a charity as well. So for people that do want to leave something meaningful behind to their children or to their heirs, this is a great solution. But also for people that don't have kids, that just want to leave something maybe behind to their church or an organization that means something important to them. So Ephraim, are you seeing any questions before I move on to the next portion?
Before, I just want to confirm, can everyone see the screen, or Leon, are you the only one that's unable to? And then Dennis, if you could type in the chat or the questions, your question here. Oh, that'd be great. And then want to make sure we get to Dixon's um, question. How many years does it normally take for the cash value to reach zero on
I'd
average?
say it depends on the age of the client and the deferral period. Um, from what I'll say from, I've run a lot of these illustrations. I would say that the folks that start income within the first, 1 to 5 years, that typically lasts longer than if somebody were to wait 10 years. Because for the people that wait, we do have that 10% roll up that is guaranteed for 10 years. But when you wait 10 years for income, that income base gets really high, which, of course, guarantees very high income, which depletes the account value a little bit faster. So if somebody were to start income, say in the first, 3 years, typically I see it last longer because, they're taking a slightly lower withdrawal rate because they didn't defer as long. So, this scenario that I showed a little bit ago, this was a 30-year illustration. This is a 65-year-old starting at 66, and it zeroed out around when they were 92. But of course, I know every situation is unique. Clients, when they want to take income. So I'd be happy to run this myself, or have my internal wholesaler run it as well.
Perfect. And then
Um,
another question here is, could we go over the fees for different riders in this annuity? Are the fees based on the initial funding or on current
yeah,
balances?
absolutely. Let's go to that. So in the bottom right, these are the all-in costs on this product. So we have the rider expense, that's the protected pay, the 1.1%, and then the death benefit expense is 45 basis points. Something that's very unique about Lincoln and this rider is that 1.1% rider fee is based off of a reducing value. So that rider fee is based off of the income base minus the withdrawals that they've taken out. So say, for example, the income base is $550,000 and the client took $250,000 in withdrawals, their rider fee is based off of $300,000. So the more income they've taken, they're actually paying that rider fee based off of a lower value, which is very unique. Most FIA income riders out there, that rider fee will always be based off of the income base, which is not reducing. So that 45 basis points, that's always going to be based off the death benefit. And then that 1.1% is based off of the income base minus withdrawals, which will decrease over time.
And then also want to add one other one from Dennis. Do we have to take income or can we take distributions like 10% free withdrawal, et cetera, and then stop it before it's empty?
Yeah, so you can take 10% free withdrawals, but anything above the guaranteed income amount would reduce the death benefit. So here are the payout rates for each of the ages. Say, for example, a 75-year-old, as long as they're taking the 6.6% withdrawal or less, or their RMD, it will not impact the death benefit. If they did take a 10% free withdrawal, anything above that 6.6% would negatively impact the death benefit. So while you can take a 10% free withdrawal, there wouldn't be a surrender charge. It would negatively impact the death benefit. So you want to take the guaranteed income amount or less.
Awesome. And then Josh here, are wanted to bring up a strategy here about internally converting it to a Roth after years of income based off the account value for the death benefit play.
Yeah, yeah. So yeah, you can do a Roth conversion. So yeah, say for example, you open up an IRA, you turn on the income, spend it down, and say 10, 15 years down the road, you do a full Roth conversion. Yeah, you could absolutely do that. And then that death benefit would pay tax free.
Do we have any other questions before we keep going on?
And that was actually here one of the strategies in this brochure, number 5 here, doing a Roth conversion um, to leave a tax-free death benefit.
Jack, do you have anything else you want to go over? Or?
Yeah, just a couple more things. Wanted to go through, what's really important, in this as well is some of the strategies behind what's driving this. So we have fixed account, trigger strategies, cap accounts, as well as participation strategies. What's been driving a lot of the allocations on our participation strategies has been the Capital Group Dividend Value ETF. A lot of feedback that Lincoln has gotten from agents and advisors is that they want access to a strategy outside of the S&P that does not have any volatility control or risk management. So we have the Capital Group Dividend Value ETF. The ticker symbol is CGDV. Again, it's an actively managed from American funds and Capital Group. Has outperformed the S&P 500 since inception over the last 5 years. So it's been really great addition that we added just a few months ago. And lastly, when you're looking at a company for a guaranteed lifetime income strategy, who better to do it than with a company that's been around for over 120 years? We have A ratings or A plus ratings across the board, and we have very strong financials. So when you're looking at a company to guarantee income for, potentially 30, 35 years, you want to do it with going to be around and will service your clients. So anyway, that was really all I had for you all. Just clients to consider again, RMD clients, clients with a large age gap, anyone facing the income legacy trade-off, uninsurable clients, clients using it to fund life insurance or long-term care. And again, I'm not saying this is, better than a higher income strategy. It's different. And truthfully, a lot of the cases that we have been doing on this have been split cases where, half the money is going to a higher guaranteed lifetime income option. The other half, they're guaranteeing that death benefit while also providing very strong income. So that's all I had. I would be happy to answer any other questions that come up if we have them, Ephraim. I think you're muted, Ephraim.
Sorry about that, guys. Roy was asking, what indexed annuity product is a state lock available with?
The OptiBlend Income. And we have it available in a 7-year and a 10-year.
And then Steven was asking, can you open the account and start income immediately, or must you wait 1 year?
So with the estate lock, client has to wait 1 year for income. So we have 2 income riders that we launched a few months ago. One of them is just the protected pay, and one of them is the protected pay with the estate lock, which is what we've primarily talked about. The standard protected pay without that estate lock death benefit does allow immediate income. But if we're using this estate lock death benefit, you just have to wait 1 year.
And to add on with what Jack just said there, if we're only using the OptiBlend with the protected pay, it's extremely competitive for what we like to call here as a midterm deferral. So if you have a client around about 55 to 60, 50, 60 even, and they're looking to retire soonish, this is going to be where it's most competitive with the deferred 3 to 5 year income schedule. It's beating out a lot of our other annuity products for income on that side. So it's a very competitive annuity out there right now. Henry asked, how many additional states is this product going to be available?
So this is approved in all states except California and New York. New York is not going to happen. California is pending approval. Lincoln has hired outside counsel to help with, the California Insurance Department and getting this approved. So it's been about 4 months now since we launched this, and we're still waiting on California, but all states outside of those 2 are approved.
Anyone else have any questions? Well, one other question that came across here is how do you get contracted and start selling this product? I'll take this one, Jack. I'm about to send a link here in the chat for everybody. You can use that, and as well as with the replay, we'll be sending the link to get contracted with Lincoln for annuities. Believe Jack and I were discussing everybody that was on this call. If you do decide to get contracted with us, there's going to be a rush, and your contract can be expedited, so you have access to this product as soon as possible. So we'll get you that link. You should have that in your inbox by around noon, 1 p.m. Pacific Standard Time today. And then with the contracting steps. And if anybody would like to run through some scenarios, reach out to myself, or if you're working with somebody here at Dunhill already, we'll be more than happy to run those scenarios for you and answer any questions you may have. And then before we wrap things up here, does anybody have any dying last questions? What is the max age, Jack, for this estate lock and then also for the Opti?
Yeah, max issue age for the estate lock is 75. We issue through age 75, so they could be 75 in 11 months. For the protected pay without the estate lock, we issue through age 85. So they could be 85 in 11 months. And there's no medical check or requirements whatsoever.
Leon, do you have any questions or any more? And Leon, I'll reach out to you if you want to run through a scenario you have with the client. More than happy to run you whatever illustrations you want to see. Well, I think I don't see any more questions coming in. I see people starting to get out of here. So again, thank you everybody for your time. If you can, any other questions, don't hesitate to reach out to myself or anyone at Dunhill here. We're kind of Jack as well. We can get you anything, answers to your questions. And thank you again for your time.
Thanks,
Jack,
everyone.
we have one more, Jack.
All right.
Oh, nope. Thank you, Tony. Bye, everybody.